Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research.
And I'm Corey McLaughlin. I'm editor of the Stansberry Digest. This week, Dan talks with Marko Papic, chief strategist at Clocktower Group.
And for our opening rant, we'll talk about some of the insights and ideas we heard at the annual Stansberry Conference in Boston last week.
No mailbag, but remember, you can email us at feedback@investorhour.com or call our listener feedback line 800-381-2357 and tell us what's on your mind.
That and more right now on the Stansberry Investor Hour. All right. How you doing?
Good, Dan. How you doing?
Very well. I'm tired, though. It's been an eventful 3 days here. A very busy 3 days here in Boston. I think I've been on stage 15 times.
Yeah, you've been on stage a lot.
Yeah.
I haven't been on stage at all, so I should be fresher, but I've been writing, so.
Well, yeah. I mean, you do, like I do 10 times more on stage stuff. You write 10 times more words every week. So, the two of us have a lot to do here. And let's face it, you basically have to watch every presentation, don't you?
Yes, watch or at least listen to. I've been bopping up between my room, writing and listening to you guys and our guests. So, yeah.
So I didn't get to see a whole lot of them because of having to do other things. I know that of the speakers I saw, I definitely have a favorite. Do you definitely have a favorite?
I do.
Yeah.
Should we?
Let's do the big reveal on our favorite. That's right. Yeah, you first.
I like the Colonel last night. I don't know if you caught him.
I only caught a little bit of it, but the gist was something like, Putin's a jerk and Russia's not as powerful as people make them out to be. And so, this war is probably not going to go his way. Basically.
Yeah. Like it was interesting just to hear from somebody who's that close to, or literally works in the Pentagon, Jonathan Schaffner, who's a friend of Joel Littman's, took so many questions from people too that were interested in just his take on all kinds of things. That he was very open and honest too for a government guy. So it was fascinating to get like an unvarnished kind of look at the war in Ukraine, where it could be going, the mistakes Russia's made. It really just in general sentiment gave you a feeling that what's portrayed in the media with this war is not what the government, U.S. government sees. And there's just this disconnect out there that people think Putin is really in control here. And from everything he was saying, it's the complete opposite. And it, could be over soon, could not, or could drag on for a while. There's also a lot of unanswered questions. Interesting. Well, the disconnect between media and reality isn't hard to believe these days, especially. But my favorite one was the keynote speaker, Scott Galloway. Really brilliant guy. I've read his book, The Four, which is about Amazon, Apple, Google, and Facebook. And he did a few things that I found refreshing, and things that I agreed with, and things that I didn't know he was going to talk about. Like when he talked about Tesla, I would have expected something else out of him, but he just said, look, it's a car company. And I wanted to cheer because it is. People talk about it like Teslas are, iPhones or some, fantastic brand new product that's revolutionizing the world. No, it's a car, and it's got all the problems of a car company, and the big one being competition, right? And it's not a great business, and there's no reason for it to be worth more than like the next X number of car companies combined. And I think at this point that number is 4 or 5. So, and it got as high as 12 at one point. It was worth more than the next 12 publicly traded car companies combined. Right. Yeah. Sign of a top there.
Yeah. And then he talked about Facebook, Meta Platforms, the company that's now called Meta Platforms. And he made this point that I thought was brilliant. He said, Mark Zuckerberg wants to basically subsume the entire world into his virtual world so that he can control it. And he's a megalomaniac, and I hope he was like, I hope he fails at this. I hope they spend tens and tens of billions of dollars and go broke and go away, because that's what needs to happen. And I was cheering at that too.
Yeah. I also really like the point he made about Elon Musk and the Twitter acquisition, that if it goes through, and he thinks it would, because Elon Musk just doesn't want to go to trial, and he's a habitual liar and doesn't want to go under oath, and that the acquisition would be the second worst acquisition in history when it does happen, behind AOL Time Warner, because Twitter's such a bad company, but it's a popular platform, and it hasn't been able to monetize itself at all. So
and what was he made a prediction. His presentation was about his predictions that he and his company have made, or maybe just the ones he's made.
Yeah, it was 10 predictions he made for this year, and he was reviewing them.
Right. And Twitter gets acquired was one of them.
Yeah.
And it looks like he's going to be right. So didn't surprise me. He's a very smart guy. I love his view on those 4 big tech companies, but we'll talk about that another time. So I was on 2 panels on the third day of the conference, which is today, and I heard a lot of things that were really interesting to me, and found out a lot of things that, for example, like, God, I could just pick one. There's so many. Dave Lashman talked about this French company, that owns satellite slots up in the sky. It's hard to explain the asset, but, Dave is so interesting, and he just talks about all these complicated technical things all the time, but in a really fun way. So he taught me something. And, I could probably sit here and list a bunch of things, but the point is, you come to these things thinking that like all the people that you work with, what they're going to say, but you really don't. Brian Beach did the same thing. I forget the business it was. It was a very, very interesting business, a new business in a new industry. Again, I thought I knew his approach. I thought I knew the kind of companies he covers. It's really cool. We work with a great group of people. I'm pitching all the people I work with is what I'm doing here. And I'm doing a bad job of it, but they are an incredible group of people, and I was really impressed.
Yeah. What struck me earlier today when you guys were up there with you, Doc, Matt, for the Bull, Bear, or BS panel. Right. And you ran through 10 news items and basically had to give your thoughts on it. And Doc made the point, we all, we don't have one view here, but it's we present the information and the research, and people can fit that into their kind of construct, I think was the word he used, which is a good way of, I think, describing what goes on here. This is actually my first one of these conferences that I've been to, and there is a lot of information. I've been trying to highlight it each day, but really I think you can get a good sense of what other smart people are thinking or talking about, and whether you agree with it or not, you can kind of fit it into, how does it fit into your plan and what you want to do moving ahead.
Yep. Austin Root made the same thing during the Best Growth Stocks panel. He said, you get the unvarnished truth, I think was how he put it, from every analyst. They tell you what they think. There's no groupthink at Stansberry Research, is what he said. And he's right. You get, when you read Dan, you get Dan. When you read Corey, you get Corey. And that is it, which is great, because all over Wall Street, and basically in any financial institution, it has to be groupthink. They can't have a bunch of people thinking a lot of, maverick thoughts and, go in their own way. It just doesn't work. That's not the way their business works. But that is exactly the way ours works. And I'm damn proud of it, I have to say.
There you go. It can be, honestly, it can be difficult for subscribers or readers to maybe make out what.
Admittedly.
Yeah. But
yes.
That's why I say, and it was for me when I first started, okay, so-and-so's saying this, so-and-so's saying that. Where do I come down on it? And eventually you have to realize, these are the different type. There's every different type of investing kind of research offered. And just
Right.
make your own decisions.
Yeah, admittedly, you're getting a lot of different viewpoints from Stansberry. If you become like an alliance member, you're going to get 200 stock picks a year, and I don't even know how many analysts we have now. I used to know that number, I don't know it, and all their different views. But I will say this for a good example. You would think if you read my stuff and then you read Matt McCall's stuff that we're on opposite sides of the spectrum. But we're really not. We agreed on a bunch of stuff today on that Bull Bear BS panel.
Yeah.
And I'm glad that our attendees got to see that. And I gave me the idea, like, Matt and I need to get together and show people really how close we are on some things and maybe we're far apart on others. And then, of course, if Matt and I need to do it, which other pairs of analysts need to do it?
Right.
So I think we can do a better job of fixing that one issue with Stansberry, which is that there's so many things you don't know which one to pick. But this is low-hanging fruit, man, because there's so many ideas that you can juxtapose, like me and Matt, or me and Doc, or Doc and Steve, or Steve. There's a lot of low-hanging fruit there to pick.
Yeah, and how they fit with each other, or how they don't, or
right.
Yeah.
How what do they agree? What do they disagree? Where do they overlap? And does that imply a strategy? There's a lot of potential here, and there always has been in Stansberry because we've always had that freedom of ideas.
I always say I always love when different people reach the same conclusion by completely different methods. So,
yes,
like energy stocks, for example. Last year, there was, I think, 3 or 4 different editors that all landed on energy stocks for not exactly the same reasons.
Yeah.
And so if you're a reader and you see that, like, that's a good one.
Yeah. Energy. That's right. Those are, well, in general, like, I like the topics for what you and I talk about to be things you can't avoid. When you get 4 Stansberry editors coming from 4 different perspectives lining up on the same trade, maybe you can't avoid doing that. Right. I agree. Yep. Yeah. That's a good one. It's weird. I have to talk about something that's not financial. I have to. For anybody who's listening who has never been to the Encore Boston Harbor Hotel, it is, of course, a very nice place. It's like they took, they sliced off 1/3 of the Encore in Vegas, they lifted it up, and they put it here. And I even said, I was talking on stage one time, and I said, here in Las Vegas. And then I had to correct myself. No, Boston, because you walk through this place and it feels like Vegas.
Yeah, my first impression was Vegas without the smoke and the cold air being pumped through as much.
Right. Yeah, that's right, because the air outside is really cold. But having said that, it's in this really kind of rough-looking industrial area. It's so weird. They make it sound like it's in Boston Harbor. Well, technically speaking, it is, but it's not in that Boston Harbor. It's over here where the cheap land is, where they'll allow you to have a casino. I think that's probably what happened. You can't be this close to the real Boston Harbor with a casino. You have to be over there. So it's rather strange. You're just kind of stuck out here by yourself. I think if you go outside, like, I look out my window and there's like a McDonald's and a Best Buy, and that's pretty much it. But I found it interesting, and I also found out that we are going to be in Las Vegas next year, so it'll be a bigger version of this. Yeah. And you'll actually, you'll look out your window at 2 a.m. and it'll look like you're looking into the sun because of all the lights. I just found it odd. Thought it was worth mentioning.
It is. One of the somebody's Uber driver, I think it was Mike DiBiase's Uber driver, said that this whole area was kind of like a rundown area, and they built this and everybody's taxes went down because this place is generating all the taxes. So again, it all comes back to the money.
Yeah, very nice. That's a good deal.
Yeah.
For everybody.
For everybody around here, at least.
Yeah. All right. So, did you hear a trade here at the conference that you liked above all others, or?
Nothing. I did like Chris Igu's had some interesting, our Daily Wealth Trader editor today with municipal bonds, just showing the boring municipal bonds, showing the like clear pattern of them relative to rate hikes and what Fed chairs say and when they say they're going to hike rates and when they stop. And that was pretty compelling, very straightforward, simple. Like muni bonds should do well if or when the rate hikes stop or signal that they're stopped there, which that's another discussion if that'll happen. But he also importantly said, hey, this is the level where if the Fed hikes rates to 15%, we don't want to be in this. So that was a good, straightforward, simple one. He does that every day in Daily Wealth Trader, which is always nice. Yeah. You?
Yeah, I like the fact that Marco Papage came back. He was here last year, and he recommended oil. It was a barbell trade. It's oil and green energy technology. The transition to so-called green energy technology, it's coming. You can't avoid it, but it's the politics of it and the way it works out. It creates this kind of structural shortage of the fuel that we're actually using now, which is oil. So, and I was really interested to see what he had to say about that, because obviously it was a great one if you bought it last year, and he's still on it. He said you have to be long both of these now still, and I think I agree with him. I already knew that I agree with him. I already knew I thought that,
yeah,
but I didn't know that he was continuing it, and he is. It's going to be. It's a trend with legs, simply put.
Yeah, he had a contrarian take on things by saying the world is not ending,
right?
Which was interesting to hear, and again, something that you can hear, and whether you believe it or not. I mean, if the world is ending, then we actually ending. We don't have anything to worry about. But
right.
But the point,
financially speaking, economically,
yeah. His point, he brought up some good arguments for, why China can't invade Taiwan, why they can't piss off every other country around the world, because all these countries, they rely on, they rely on other countries that buy their stuff, and so their economy is not. They have higher debt to consumer debt percentage than the U.S. does, which is saying something. So
right, and they've shoved the command control economy has shoved, like Scott Galloway said, 94 trillion into real estate. I mean, that's a number that I can't quite fathom. It doesn't mean anything to me. It's too enormous, right? It's like almost 5x US GDP. It's a little just wow. So you might say there's a little bit of overhang there, and that'll have to work itself out. And who knows how they'll respond to it in their command and control fashion, and what the implication of that will be. So, yeah, it's I always like Marco's talk. He's a great guy, very smart. But yeah, I thought that was my favorite. That continues to be one of my favorite ideas for investors right now is oil. I'd be pickier about the green tech side of it probably than Marco. He probably knows more about it than I do. But the oil side, I think, is solid. And the other thing that I heard, this is one of the things Matt McCall and I showed everybody that we can agree on, was housing, because housing is basically, it's a structural shortage. Inventories are still low. Yes, mortgage rates have just soared out of sight in record time. Yes, that brings prices down. Okay. But eventually there is market clearing. Eventually people let go of that house at whatever price they need to let go of it. And there's just is not enough supply. There's a good reason to believe that housing is, in general, in the United States, I realize it's regional, it's local. In general, in the United States, it's going to be a pretty decent business for years to come. And we're still working off the hangover from the peak of the housing bubble in 2006. These things are long trends, right? I like that one.
Yeah, generally speaking, with Marco's, with Joel Littman, who showed some interesting data on, again, why China's not as strong as people think or may think. if anything, I actually came away with a a positive takeaway of things that maybe aren't as bad as a lot of people think. Although I also have seen a couple different people to the point of, when different people say the same thing from two different points of view, the sideways market, you're not the only one who's talking about that. I saw a couple different presentations on that showing pretty compelling evidence that U.S. stocks could be headed that way for 10, 15 years.
So basically that means flat or negative returns from the January 2022 peak, just peg it there, for a decade or more.
Yeah.
Right?
And the more I hear that, the more it makes sense to me. Just as far as this bubble we've had, end of a long bull market bubble, and then inflation where it is, it's going to be higher than 2%.
Yep.
And what does that look like? I think it's pretty compelling to me, at least. I don't know if it's going to be if I'm right about that, but I think you got to prepare for that is the point.
Corey, you sound like me. You sound like you're going to write the next issue of Extreme Value of this stuff. That's great. I love it.
I know. You got that. I'm good.
Yeah, you're good. You do plenty of writing. That's right. Lots of good ideas. And that one, I'm seeing more people embrace that one.
Yeah.
Mike DeBiase, I forget the exact title of his presentation. It was like An Economic Winter is Coming. It was really sunny and fizzy and fine, I tell you. He recommended a discount retailer, which I thought was reasonable. Those discount retailers did well in the last two recessions. They provided positive returns. Stocks in general don't generally provide great returns in recessions, but discount retailers do. And he found a good one. So I thought that was a good idea too. Probably too many good ideas to list here.
There's a lot. I have to download stuff in my brain and rewatch some videos.
All right, then. So lots of great ideas. But let me ask you this, what was the biggest surprise for you, if there was one?
Biggest surprise? I can't say I'm going to deflect the surprise part of this question, but it's nice to just see subscribers in person and see them writing down stuff that you guys are saying and really, laughing at certain things, eye rolling at certain things. Like it's that human connection part of it. We're behind computers and sending emails and that's to actually see the other person who's reading your stuff is not surprising, or although I guess it is surprising in today's world. And that was a point that was brought up by a couple different people, including Scott Galloway, about the mental health toll of these tech companies and social media. And I think the impact there on society in general has not been explored. There's no real, I don't think there's any real convincing studies or anything that have taken place because all this stuff is still ongoing. But if you're a kid and you're on your phone 8-10 hours a day, I sound like an old man, but that's not how,
right.
It's not how I grew up. Maybe I don't know how the teenage brain affects that. I don't think anybody does because all this stuff is ongoing. So anyway, that was a strange curve to that question. But my point is the in-person stuff is what it was a nice surprise for me.
Well, we're overlapping substantially here because, Scott Galloway's mention of that whole, of the social media, young people on cell phones and, smartphones, having it be a very damaging thing to them socially. That was mine. So, we're copacetic here. But the surprise though for me was when he started talking about, the damaging effects of social media, and then he kind of went off on an interesting tangent and he started talking about lonely, depressed young men, and that is a bad thing for our society. And I'm I usually pull back when somebody says this is bad for our society, and you should feel the same way. Like I feel the same way when I say it, right? But when something's bad for our society, I think, oh, okay, what do you know? Our society is so diverse, and you don't really know what's good or bad for it, do you? But I kind of had to agree with him. Like young men being extremely lonely and like having, record low levels of sexual activity and not starting families and,
Yep. Something that's not talked about.
Yeah.
But it's there. I mean, anybody in that
is.
age group, I think, knows that.
Right. And I wish I came away from that. Scott's a very wealthy entrepreneur. He's been very successful. And I came away thinking, I wish more people like him would be less like, Bill Gates, the megalomaniac running around the world trying to take control of everything, and more like Scott Galloway, talking about the importance of relationships. He had a whole bit on relationships and this problem of these lonely sort of young men.
Yeah, that was a common theme on the first day, I think, about relationships, and happiness is really relationships. That was said a couple times. And I think people are just looking for that in the post-lockdown pandemic world, and forgot about it.
So, all right, well, good to talk with you as always. And I think what we'll do right now is we will talk with Marko Papic and hear it straight from him. Can't wait for everyone to hear this guy. He's brilliant. He's been on the show before, and he's back with us today. Let's talk with him right now. Here comes Marko Papic coming at you right now. Wake up, Stansberry Investor Hour listeners, because a major market event is right around the corner, which will take most Americans by surprise and likely ruin millions of retirements. I'm stepping forward to expose exactly what's about to happen and how it could change everything you know about investing. You might not know this, but I'm the longest tenured analyst at Stansberry Research. And over my 20 plus years at the firm, I called the Lehman Brothers collapse 5 months in advance, the Bitcoin crash, even the top of the NASDAQ last November to the day. But what I'll be sharing with you is by far my biggest and scariest prediction ever. In short, what I think is about to happen has the potential to destroy everything you spent your life working for and will require a totally different investing approach going forward. To find out more, go to www.danmarketprediction.com. Again, that's www.danmarketprediction.com. Oh, and just for tuning in, I'll give you the names of two well-known stocks you've definitely heard of and might even be holding, which I think you need to sell immediately. These are two of the most popular, widely held stocks in America right now. So there's a really good chance you really do own at least one of them. And if you do, I think you need to get out immediately. To get the names of those companies, again, sign up for my free event by going to www.danmarketprediction.com. All right, Marko, welcome back to the show.
Thank you. Good to be back.
Yeah. So we were talking a little bit before we started recording, and we both agreed that macro investing, it's the kind of thing where, it doesn't seem to matter for years at a time, and then it's all that matters. And I think we also agree that this is one of those moments when it's all that matters. So you're part of. I feel you're part of the Investor Hour macro posse. So I have to talk to you now, and basically it's like a plea for help. What's going on? Help me understand. And I feel like you can pick almost any reference point, like what happened in the UK, Bank of Japan intervention. Update me on what you think the Ukraine war means. So like you pick the spot, but there's a lot of them, and you can start anywhere you want. But where are we? Like, help me out here.
Well, I think the most important thing in the world right now is actually Jay Powell, unfortunately, and I say unfortunately because it's kind of boring to talk about the Fed with so many geopolitical issues that are happening. But I just go back to the day when Russia mobilized. And he made this big speech and announced, Vladimir Putin made a big speech and announced mobilization. And the S&P 500 futures dipped, and I got all these emails and messages from people like, oh my God, here he comes. And I was like, here comes what? It's a nothing burger. Who cares if Putin is mobilizing yet another 100,000 of useless soldiers that will probably get mowed down by the Ukrainians? And so the S&P 500 futures realized that very quickly. And so they rose back. And then later in the day, Jay Powell had a press conference and we tanked. So like Jay is much more relevant and powerful than Vlad is.
Yeah.
And actually, literally everything that is going on in the world is kind of irrelevant if Jay Powell continues to be very hawkish, and continues to raise rates at the pace that we've had so far. So I think that's the first thing we need to kind of unpack and discuss and think about. Because of a lot of the geopolitical issues, I can literally see Russia using a tactical nuclear weapon over the next couple of months.
Yep.
And if it does so on the day where Jay Powell says, we need to pause to reflect, like the market will be up.
Yeah.
So I think the central bank tightening, it's overdone.
Okay.
And I think that they are going to pause for reflection as Leo Brainard kind of introduced the verbiage into the lexicon, which was very important. You can start seeing them kind of make the breadcrumbs.
Yeah.
The BOJ is doing yield curve control. You've got ECB, which basically is doing yield curve control with Italian bonds. The UK basically had to institute yield curve control. So everybody around the world is already pivoting against the tightening. And so I think that's the most important variable out there.
So maybe just a quick explanation of yield curve control for our listeners.
Yeah, so basically, take what the ECB is doing. It's raising rates. It's raising rates. It's raising the cost of borrowing at the same time that it's capping the cost of borrowing for the government by buying Italian debt. The UK basically did the same. They've been raising rates to try to keep up with the Fed. And then the cost of borrowing for the country rose massively after the budget that they tried to push through with tax cuts. And so the Bank of England is both raising rates at the same time that it's buying long-term debt to cap the yields on the long-term debt.
Right. So raising short-term, capping long-term. So,
capping long-term, yeah. And so I think
yield curve control, the name. So sorry.
That's right. Yeah. No, absolutely. And I think what's interesting about that is it's kind of counterintuitive and it counters the very like what they're trying to do.
Right.
Which is why it's important, right? Because it tells you that they don't actually have the guts for real pain.
Right.
And so I don't think the Fed will either at some point, probably sooner than we think. And so that would be my first issue. Like when the US central bank, when the Fed decides that it's had kind of enough, everything else can start mattering again. Until then, it's really just all about them.
Right. So I'm going to push back a little bit, as I always do, in the idea of an imminent pivot. Okay. So it seems to me like, we all know that they lag, right? The CPI is lagging, monetary policy then lags, months. So by the time he sees, 2% CPI year over year, then he'll pivot. And what I fear is that he will really follow through on this, that these people are so model driven and so committed to this sort of theoretical kind of academic view of the world that he'll stay too focused on that, and he'll be too driven by that, and that the idea of tamping down inflation also. I mean, he's located in Washington, D.C., and inflation is like, we can't have that. So I just, every time I hear about the pivot, I get a little skeptical, and I think, no, you don't understand. He wants to break something, I feel. I feel like his mindset is...
That was the title of my last report, which is funny. No, I mean, it's... so, look, I think, that's definitely a future that I contemplate. So let's unpack that future.
Okay.
So if the Fed truly is only going to pivot once they get inflation to like under 2%, we're going to have the most calamitous recession in history of the United States of America.
Right.
Which is a future that can happen. And the other thing that I would say is that if that does happen, I would guarantee to you that inflation will then rise again. So the issue is that, so if they are committed to following what they think is the path of Paul Volcker, they will end up being Burns. And the reason for listeners,
they'll end up what? I'm sorry.
They'll end up like Burns.
Oh, Arthur Burns.
Yeah, so they will guarantee the Arthur Burns scenario. So in the 70s, like everybody basically in finance is raised in these myths, like every other epistemic community.
Exactly.
Yeah. And our myth is that 600 basis points of difference was all that it took to dampen inflation, which is one of the most stupidest things I've ever heard.
Right.
So Arthur Burns was the chairman in the early 70s, and the Fed chair, and he raised rates.
Sure.
Caused the 73, 75 recession.
Yep.
But inflation started creeping back up. And by the way, he brought inflation down from 12 to like 5%. So he was like successful. Like if we were at 5% CPI right now, real wages would be positive in the United States of America, and nobody would care about 5% CPI, politically at least.
Right.
So Arthur Burns got the job done, but then in the mid 70s, a couple of things happened. First of all, Jimmy Carter was the president, so populist, wasn't looking to expand supply, wasn't a supply side reformer like Thatcher or Reagan. On top of that, the 73 to 75 recession delayed the supply side reform response. For example, specifically, the North Sea exploration took basically 5 years longer. It took 5 years longer to bring North Sea oil online and reduce OPEC's bargaining power, which is an important thing. North Sea oil was discovered late 60s, early 70s, but 73 to 75, you're not going to invest in CapEx in the middle of a recession.
Right.
So what happened was Burns was ineffective. And then, of course, 79, 80, you get Volcker. He causes 2 recessions, not one. He raises rates 600 basis points more than Burns. And so a myth emerges that this 6'7" behemoth, Paul Volcker, is like Jesus Christ.
Right.
Arthur Burns is the fallen angel.
Right. He's the guy who didn't go far enough.
But the problem is it completely misses literally everything other than the 600 basis points. It misses the fact that Volcker got lucky with the early stages of globalization. He got lucky with the ascendancy of supply-side reforms and laissez-faire economics of Ronald Reagan and Margaret Thatcher. He didn't have to deal with unions as much as Burns did. And he also got lucky with the fact that supply finally got online after a decade of delays. And so what am I getting at? I mean, if they try to get us to 2% CPI next year, which would be I think really difficult to do, it would require massive destruction of demand. They will also ensure that we don't get the supply side response necessary for a long-term abating of inflationary pressures.
Right.
Because look, why do we have inflation? Oh, it's Biden's stimulus. Well, no. False. First of all, it's Biden-Trump stimulus. Exactly. Second of all, forget stimulus. Forget that. That's easy. You raise rates, done. Demand gone.
Right.
The problem is we have this plethora of idiosyncratic supply problems that seem idiosyncratic, that seem separate from each other. But actually, there are a cacophony of evidence that's telling you that we have completely dismantled the well-functioning, well-oiled machine.
Right. The global
supply chain, just in time, all this stuff.
Yep.
And why did we do it? We decided that global warming was going to kill us tomorrow. Not in 10 or 100 years. No, tomorrow.
Yeah.
So we need to deal with it right now.
Yeah, it's an emergency.
All right. Yeah. And the problem with that is that what we've done is we've starved fossil fuel industry of capital. We've turned off the capital tap, the CapEx tap, at the same time that we didn't turn off the demand tap. Like, we're not all driving Teslas. Sorry.
Right.
Some of us drive F-150. So the problem with that is that we have an energy crisis, which is of our own making.
Yep.
We have a supply chain crisis, because 5 years ago, we all thought China was cool. Now we all think China's going to kill us.
Yep.
So now we have to also fight a war with China tomorrow.
Yeah.
We have to solve climate change tomorrow.
Right.
And then finally, of course, COVID. I guess that's nobody's fault, but COVID disruptions also created supply chain problems.
Okay, Marco, I feel like what you're telling me is that on more than one front, we're on a wartime footing, and that's generally an inflationary impulse.
Yes, and it cannot be resolved with Jay Powell and 300 PhDs in economics following models, as you said.
Right.
In other words, I can't believe that 300 PhDs at the Fed are that dumb.
Okay.
And that I, writing research on the beach in Santa Monica, California, I'm smart. What I'm getting at is this. If you're right and they cause inflation to go to 2%, they will also delay the supply response necessary to resolve.
They're crushing demand. They're not fixing supply. Period.
And the issue is supply.
Yep.
If you go to the San Francisco Fed website, the San Francisco Fed has all these models on like whether it's demand or supply causing inflation. Now look, like all models, it's probably whatever. You can drive a truck through the assumptions, but generally speaking, their assumption is like 60% supply, 40% demand, which I don't think is crazy. We might quibble. You might say, no, Marco, it's 70% Biden stimulus and demand. But still, there's that 30% supply. The point is, if we get down to 2% inflation, we're going to have a calamitous recession. We're not going to have a CapEx response. Like, you're not going to rebuild supply chains. Oh, but China's evil. Who cares? If there's a recession, no one's building a factory for chips anywhere in the United States of America. You can throw all those cool, fancy national security bills they just passed into garbage. We're not sinking more money into fossil fuel industry.
So, and Volcker's actions were on the end. And inflation is great for CapEx, right?
Well, no. Inflation is, but not a recession.
What I'm saying is I'm amplifying your point here.
That's right.
We don't have, the circumstance is kind of opposite at that point. The recession crushes the CapEx, and then you're back where we are right now.
Exactly. So what I would say, that's why I said, so I think they'll pivot, but I want to but whatever, it's a low conviction view. I'm not gonna like hang my hat on it.
No, we're basically making a prediction here, and you don't bet your whole wad on a prediction, right?
Absolutely, so, I just want to also, for the listeners, like articulate exactly what your scenario means. And I think that if they are committed to the legacy of Volcker or the myth of Volcker, if they are committed to that, then I guarantee to you right now, inflation will not be under 3% for the rest of this decade in non-recessionary quarters. In other words, they will absolutely miss their target for the rest of this decade if they try to end the cycle now. We're just not going to get the supply side response, and they're going to end up being burns no matter how high they raise rates.
Well, so you started out telling me they've already gone too far.
Yeah.
How, we could be there, right? I mean,
we could. No, I think a recession
recession in 2023 sounds like done deal.
It's not deal. If you look, so what do we use to predict recessions? I mean, who knows? Nobody knows. But what I like to look at is, real non-residential investment. So I want to look at investment, like CEO decisions to do CapEx, basically. And they're really useful, not so much that this is an investment or CapEx-led economy, but they just tell you where the animal spirits are. And then you can create a chart with CEO confidence as well. So CEO confidence and their investment decisions are pretty much like coincident. CEO confidence right now is lower than 9/11, 2008, and COVID. Now, investment is still right on the brink of becoming negative, on an annualized change. So the chart looks like CEO confidence has gone through the floor and investment is right there. And investment should follow CEO confidence. The two charts are basically they move in sync over decades of US history. So what this tells you is the animal spirits of business leaders and owners is crushed.
Commercial risk takers, not willing to do it.
Not willing to do it. And if that investment collapses, then everything else will collapse. Now, Jay Powell keeps talking about slack in the labor market. Again, I can't believe 300 PhDs at the Fed are stupid. They know labor market indicators, all of the labor market indicators are the last thing you look at. I mean, nobody cares. That would be
it's the end of the chain.
It's the end of the chain. Yeah. Nobody. So look, if they want slack in the labor market, by the time you see it, it is too late, as you said earlier. And so, I think the question now is, are they aware of the heterogeneity, the complexity of the inflation problem? Are they aware that it's not just demand, that it's not just Biden stimulus? And I think the answer is yes. So to push back, So I gave you kind of my view of what happens if
in that
scenario.
Right.
Oh, and by the way, it's not just like one last thing about your view. Like if that happens, what should we prepare for?
Yeah.
We should also prepare for 2024 election to produce non-market friendly outcomes. And what I mean by that is that also happened to Burns as well. He didn't get a supply side reform politicians. He got more Jimmy Carter. He got more populism. I guarantee you right now, we get a recession 2023 that's deep. We go under 2% CPI. 2024 is going to be a poop show. I don't know. I think this is a family-friendly podcast, so I'm like holding back. And I mean, like, I don't care, right, left. Like, I bathe myself in nihilist indifference. Like, my job is to forecast this. It doesn't matter. We're not going to get someone who's going to say, like, hey, hold on a second, guys. Let's get more supply on the market. That's not what we're going to get. That also then prolongs the inflationary world because we get more populism.
Yeah.
And so let's go back to the other, like, imminent pivot. I don't know if it's imminent, right? It might not be imminent enough, but my view is this, like, I think that they're driven by politics and they have no idea what they're doing. So I would say, I'm going to take the other side.
Not going to argue that. I mean, it's
model schmodels, I don't know if you've ever heard of SOOMA modeling, SOOMA modeling. Have you ever heard of it?
No, I don't know SOOMA.
Straight out of my beep.
Straight out of my ass. You can say that.
I can say ass?
Yeah.
All right, good. Look, 2021, 300 PhDs in economics at the Fed got inflation wrong. A bunch of people like me got it right. And I cheated on my macro 101 from my roommate, like the homework at my university in undergrad.
Yeah.
I got a C+ for macroeconomics in my undergrad because I cheated on the homework. I'm just going to say that straight up.
Okay.
And I got it right. It was so obvious we were not in a transitory inflationary world. So why did they then think it was transitory? I think it was political. Joe Biden got elected. He wanted the extra fiscal stimulus. He didn't want the Fed to start raising rates. And so they didn't.
So transitory is a pure political narrative.
Yeah.
And do we believe that they knew this from the first time they used the word? Jay Powell used it 5 or 6 times that first time.
I don't know. But you know what? They said all sorts of stuff. It wasn't just that. I think Leo Brainerd was the one that said, or maybe Yellen. Okay, she wasn't in the Fed, but there was another one, premature tightening would cause majority of Americans to feel unwarranted pain.
Like Bostic or somebody.
Yeah, so one of the doves said something like, hey, let's not tighten prematurely because it will hurt. So in 2021, it was like, hey, let's take it easy. Let's be gentle. Let's caress the economy. It's like, guys, there's going to be inflation. By the way, meanwhile, in emerging markets, every single central bank is like, inflation, let's raise rates.
Yeah.
Right?
Yep. Every single,
all emerging market, the Brazilians, the Indonesians, the Malaysians are like, no, we're going to raise rates. I don't know what you guys are smoking, but over here, in this country, we raise rates when there's inflation.
Because we're at double digits over here.
Well, and they weren't even.
Well, not at that time. Not at that time.
They were just like, hey, look, I mean, COVID's over.
Right.
So we're here waiting for 12 months. Then what happens is real incomes in the US, real wages start to turn negative. And then it becomes a political problem. Consumer confidence starts collapsing, as does Biden's popularity. And so he makes a big speech about how inflation is a big deal. Jay Powell gets reappointed, and then boom, we're going to fight inflation. Okay. So now 12 months after that, so that was end of 2021 when they saw saw Paul Volcker, then they're going to start fighting inflation. But again, it was the pivot that the Fed happened almost at the exact same time as Biden finally read through his Twitter feed and was like, oh, hashtag inflation is trending.
Yeah.
Now that hashtag recession is trending, I'm supposed to believe that they're going to be model dependent. I don't think so.
Yeah.
So that's I think they're going to, Leo Brainerd again, I think it was 2 weeks ago, she's the dove. For those of you who don't follow the Fed, and I do not blame you, it's boring. Yeah. She basically said, look, it may be time for us to reflect on the consequences to the real economy of a really fast appreciation of rates.
Right.
Which to me sounds like they're setting up for another transitory. It's going to be reflection. We're now going to reflect for some time in 2023.
Right.
And again, because hashtag recession is now definitely trending more than hashtag inflation. They just need the CPI to come down. And once CPI comes down from 9% 8% to like 6%, 5%. The truth is, real wages in this country will be pretty much flat, if not positive.
5-6%.
Yeah, so real wages are basically like, wage growth minus inflation. And right now they're deeply negative because wage growth is 4 to 6%, depending on how you calculate it, which data you use. 4 to 6% inflation, real nominal wage growth minus inflation,
right,
is right now negative. It's like -4. So if you get CPI from 9 to 5, you're sitting pretty as a politician. Long-term expectations of inflation, be damned. And so I think that's what's going to motivate them to pivot. And again, it's going to motivate them to also pivot because they're aware that there's supply issues. They're aware that like they're not going to fix supply issues with raising rates. And so that's where I think they land. And also the other issue is that they're starting to break things, as you said. It's not the equity market that they're breaking, but they're breaking like American geopolitical allies. So normally when the Fed raises rates, what breaks is like Malaysia or Thailand or South Korea. Right. Or Russia or Brazil. And then it takes like 12 to 18 months for all that global stuff to round trip back to the US. You have like an LTCM crisis or something.
Right.
This time around, like it's literally the United Kingdom that's having a balance of payment crisis. It's, like United Kingdom, the Bank of England, they have the Fed on speed dial.
Yeah. So the fear extrapolator in me, we were talking about breaking things, looks at like what happened in the UK and says, and Hugh Hendry talked about this when I interviewed him recently. He was like, it like opens the kimono for the world on repo, and people don't know anything about this. They don't know that these huge financial companies and other companies are funding their business billions to the tune of billions and billions of dollars every morning at 8:30. And if it's not done by 11, there's a big problem. And there was a big problem in the UK. That to me, like that's the kind of breaking. It's like Bear Stearns. Exactly what I just said happened to Bear Stearns.
But there is a difference though.
Okay.
There's an important difference.
It's not Bear, it's UK, it's England.
Yeah, exactly. And there's like, what I'm getting at is, look, the big difference here is whenever people get technical and your eyes glaze over, as mine do, like it's like bullshit.
Yeah.
It can be easily fixed. Let me explain. Bear Stearns wasn't Bear Stearns. Who cares about Bear Stearns? What happened in 2008 was a real estate crisis. Like that was the problem.
Right.
We have a sovereign debt crisis, but that's not a crisis because it's easy to throw tens of millions of Americans out of their homes. That's easy. That's actually easy because they can't print their own money.
Right.
So nobody cared. But when it's a bunch of guys who went to elite schools and are running countries, they're just going to be like, oh, wait, what's the problem? Some repo market thing that like Hugh Hendry knows about and that he's going to talk about? That was the sound of a printing machine.
Right.
Like, so this is where I'm getting at.
True.
2019, no, wait, what was it? Late 2019. Same thing happened. The Fed was raising rates and we got a repo market crisis.
2019 or 2018?
Now my brain stopped.
September to December.
No, 2019. It was 2019. Yeah. It's 2019.
Okay.
And there was all this really complicated research being pumped out by investment banks.
I remember this. Yeah.
Credit Suisse guys, Zoltan came out, wrote some piece that literally melted my brain.
Yep.
And I was sitting there and all the young guys in my firm were like, Marco, this is it. This is when it ends. And I was like, and what ends? The cycle, like this. And I was like, you do realize they're going to restart QE, right? No, man, no, it won't happen. It was like, boom, they restarted QE.
Yeah.
You and I can't even remember when it happened.
Yeah, it's nothing.
It's nothing. So this is where like my pivot thesis comes from because the kimono is removed, as you said. Yeah. And it's like the bubble. Where's the bubble? Where's the bubble? Everyone's looking for the bubble. The bubble's in sovereign debt. That's the bubble.
Yep.
The bubble is not poor, regular folks who can be thrown out of their homes and made homeless. No, the problem is governments. And so what are the governments going to do? They're just going to do printing, which the fancy term I brought up at the beginning, and I apologize for that, was like yield curve control. I should have just used the printing sound, like brr. They're just going to turn on and buy their own debt, which then negates the interest rate like hikes. So I hate to harp on monetary policy, but so many things matter. What I would say is that if you're right, we have a path. We know what happens.
Mm-hmm.
If I'm right, we have a path and we kind of know what happens, which is that the cycle continues.
Okay.
But one thing in the near term probably that makes the most sense, if you're right, we have a calamitous recession.
Yeah.
Bonds are going to rally.
Yep.
If I'm right and they back off, then the front end has to stay where it is or come down. And then the back end, which is long dated bonds, will also come down.
Yep.
So I got to tell you, and I know this is dangerous, this year, worst trade in the world, but I'm just sitting here and saying, like, how can bonds keep selling off? Because it seems to me that whichever path we take,
they're going to have to rally.
The long end has sold off too much.
Yeah. All right. Well, yeah, you're not the only person I've heard say that, but I'm going to give you my final question. If you could real quick do the bit that I always do at the end of every interview, for same question for every guest at the end. If you could leave our listener with just one thought, what would it be? And if you've already done it.
No, I don't think we've done it. I would just say that one thing we didn't talk about is obviously geopolitics and politics. It's just a really weird moment right now where monetary policy is driving everything. But I would say that, look, just start arming yourself with knowledge of politics and geopolitics because they are going to drive markets. Right. Once we get an answer to our question, like, is Jay Powell going to follow Volcker or not? Once we have the answer to that question, the next decade becomes just about getting politics right.
All right. Well said. Thanks for being here. I appreciate it.
Absolutely.
All right. Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside, like Riot Blockchain before it shot up 10,090% in less than 12 months, Digital Turbine before it shot up 789% in 8 months, Overstock.com before it shot up 1,050% in 4 months, and more. Clients have paid as much as $5,000 per month to see this kind of research. But today, you can get a glimpse at his system, the Power Gauge, absolutely free. It's a new way to see which small stocks could soon be rated a buy across Wall Street and shoot up. By using a secret so powerful, CNBC's Jim Cramer once said even he doesn't want to bet against it. This Power Gauge comes from the legendary Mark Chaikin. Mark's the creator of one of Wall Street's most popular indicators, a system that appears on every Bloomberg terminal in the world and is used by banks, hedge funds, and every major brokerage site. He spent 50 years on Wall Street, survived and thrived in 9 bear markets, built 3 new indices for the NASDAQ where he once rang the opening bell. But today, Mark has turned his back on Wall Street and wants to show you how this unfair advantage works. Right now, you can get a free in-depth look at how his Power Gauge system works, a way to type in any of 4,000 different tickers and see exactly where the stock is most likely to go next, and in any type of market. Simply go to www.trypowergauge.com for your free look. Again, that's www.trypowergauge.com. Well, that was certainly the most time I think we ever spent talking about the Federal Reserve all in a row. I never would have thought that I would have let a conversation about the Federal Reserve just kind of take up that much of an interview. But obviously, there's a lot going on there. And I think Marco makes the point very well that, unfortunately, he said, they're the most important thing to listen to right now. And I can't disagree with him. And of course, you heard his view and mine, and neither one of us is making a prediction, really. We're just saying, if this happens or if that happens. And the whole world, the whole market is sitting on the edge of their seats, right? You're sitting on the edge of your seat. I'm sitting on the edge of my seat. What's going to happen? What's the Fed going to do next? So it made a lot of sense to kind of cover the various scenarios today. And I hope it's as valuable for you as it is for me, especially to talk with a guy like Marco about it. Well, that's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. We provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_hour. Have a guest you want me to interview? Drop me a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show.
Thank you for listening to this episode
Till
of the
next week,
Stansberry
I'm Dan
Investor
Ferris.
Hour.
Thanks for
to
listening.
access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.